Hi there, welcome to Kneppy Invest. Excited to be bringing you this video today as I am recording this, the second last trading day of October. And typically the last trading day is quite busy because the majority of companies that have to release their quarterly report just decide to release it on the last day. And not only that, taxes have to be in by midnight tomorrow. Fortunately, I've done my taxes, so I don't have to worry about that. And I did my taxes because I knew October 31st is busy. And hopefully I get no Halloweeners coming knocking on my door in the evening because I have no candy to give them. Anyway, final Appendix 4C for Volpara. This could be exciting for shareholders because one of the reasons why this company doesn't have to do any more Appendix 4Cs is because Volpara has been operating cash flow positive the last 4 quarters. And in this particular Appendix 4C, they actually mentioned, this is it, no more, according to some rules. And I'll talk about those rules in a second. Now, for those who don't know, Volpara, fairly exciting company, and I wish all the best for this company. I hope they succeed because of what they're doing. And even though I actually do like this company, and I'm pretty bullish about the future of Volpara, I have never been a shareholder of this company, which actually does surprise me a little bit because of how bullish I am in regards to Volpara. So, clinically validated AI-powered software for personalized screening and early detection of breast cancer. Since its inception in 2009, Volpara has become a world leader, that's the company's words, not my words, in automated breast density assessment and is the density measurement tool of choice for breast cancer research. Again, that is the words from the company. Maybe they are the measurement tool of choice for breast cancer research. Maybe they are. Maybe they're absolutely true. The company now boasts world-class vendor-neutral software expertise in breast cancer risk assessment, volumetric breast density, mammography quality, and artificial intelligence and machine learning. You'll notice in all the words I've said in the past minute or so, they've mentioned AI twice, AI-powered software and artificial intelligence and machine learning. And I'd say most tech companies probably put the words AI or artificial intelligence somewhere in their presentations. Of Volpara did exactly that in their Appendix 4C, their very last Appendix 4C. And here is that bit of commentary. If you don't believe me, management mentioning this will be the company's last Appendix 4C. Well, they don't explicitly say this will be the final Appendix 4C, but they did say following Volpara's achievement of 4 consecutive quarters of positive cash flow, operating cash flow, the company is no longer required to, or by ASX, to release an Appendix 4C. They did say, however, Volpara remains committed to providing regular operational and financial updates to its shareholders and will therefore release business updates periodically. So even though they don't directly say this will be their very last Appendix 4C, they do sort of imply that in this particular bit of commentary. Now, a few other facts in regards to Volpara. The CEO is Terry Thomas. This company, I've already mentioned, founded in 2009 and listed on the ASX in April 2016. So we're talking about 7.5 years on the ASX. And that does surprise me because I still remember when this company IPO'd, and I did a little bit of research on Volpara when they did IPO, and I did actually like the company back then, even though they didn't have a lot of cash receipts. And cash receipts have grown a fair bit since then. And we'll look at the cash receipts history later in the video. Shareholders, one of the largest shareholders is Harbour Asset Management. I would believe that's a New Zealand-based company or fund manager because Volpara is a New Zealand-based company. Pretty sure Terry Thomas works out of New Zealand. I might be mistaken in that, but I'm 95.62% sure. And Harbour Asset Management hold 14.9% of Volpara. And I'm pretty sure Harbour Asset, or the harbour butt of that company, is in regards to Auckland Harbour. I could be mistaken. I am known to be mistaken a lot. And the market cap of Volpara at 71 cents is 181 million. Now, I haven't actually had a look at the share price of Volpara recently, so let's have a look right now. 69.5 cents. So actually, the market cap of this company is more like 175 million or something like that. Not too high for a company that has in the past had a significantly higher market cap, yet was burning through a lot of cash. So the company is better placed right now than it's ever been. And even though it is better placed right now than it's ever been, the valuation of the company is significantly low. And that just shows you what state of the market we're in right now. And the companies that have been affected by the state of the market we're in right now are those companies that have not been profitable. And Volpara's ticker code is VHD. Now, I just Googled Harbour Asset Management, and actually we're founded in Wellington. So maybe the Harbour is there a Harbour in Wellington? I think there might be. Anyway, before we have a look at the September quarter results for Volpara, their financial year 24 results, let's go back to last year just to see how this company has progressed. And remember, this company has seen 4 quarters of positive cash flow, which means 1 year ago they did not have positive cash flow. So we can really see how this company has improved financially in the past year. And this company has really turned a corner. And that's one of the reasons why I might be a little bit surprised that the market hasn't really reacted to how this company has, I wouldn't say turned things around, but they've really striving to becoming profitable and free cash flow positive. Because 1 year ago, even though they had $8.8 million of cash receipts, and this is in New Zealand dollars, they were operating cash flow negative by $3.2 million for the quarter, and for the 6 months to date, $6 million negative operating cash flow. So they were burning through a lot of cash. And if you look at the cash on hand, it fell from 15.2 million to 11.6 million. And then things just turned around. They went from burning a lot of cash to becoming operating cash flow positive. And they've achieved that goal during the last 4 quarters. And that is one of the things I'm looking for in all companies. I want to see a company being able to show the market that they can be operating cash flow, free cash flow, and profitable for at least 4 quarters in a row. And Volpara have done one of those, operating cash flow, for 4 quarters in a row. So let's have a look at the September quarter for financial year 24. And operating cash flow positive, 1.2 million. Receipts up 2.8 million to 11.6 million. And one of the reasons why this company has gone from burning through over $3 million of cash in 1 quarter to being operating cash flow positive by 1.2 million is not only have they increased receipts, they've actually managed their costs and their spending really well. Research and development down 500,000, whether that's a good thing or not, remains to be seen. Staff costs down 1.1 million. So that's where they have found a lot of savings in their staff. Product manufacturing operating costs up 700,000. And the main reason behind that might be because they're bringing in more revenue, bringing in more receipts, and administration costs flat. So one of the reasons, or 2 of the reasons why this company has become operating cash flow positive, they've been able to increase their receipts while keeping a lid on the increase in spending. And that's why cash on hand for this company increased in the past quarter. In fact, it increased by over $1 million from 12.1 million to 13.2 million. So possibly this company has hit a very important inflection point. And when the cash on hand actually increases, that means the likelihood of a capital raising decreases significantly. And when I say significantly, I mean significantly. It would go from nearly 100% if the company keeps burning cash to almost 0% if the company generates cash flow in their business. And typically, if a company keeps generating cash flow in their business, and if the company doesn't have any debt, the only reason a company might do a capital raising is because of acquisitions. Now, one of the reasons I really like Volpara is when you look at the receipts history, this is exactly what you want to see for receipts. I do this also with more mature companies looking at revenue. I want to see revenue increasing through time. It's the first step I take in assessing the quality of a company. And if I see receipts or revenue increasing through time, that does not necessarily mean a company is high quality. It just means there's a bigger chance, a bigger likelihood the company is high quality. You don't see many high quality companies not increasing their revenue or receipts through time. Just think Telstra. In fact, Telstra has gone backwards over the past 25 years since it's listed. Share price has gone backwards. So there is a relationship between receipts and revenue growth or lack of growth and shareholder return over time. There has been research done on this. It's one of the best indicators for beating the market returns by finding companies that are able to grow their receipts or revenue through time. And if a profitable company can increase their receipts or revenue through time, that's even a better sign. And it looks like Volpara is moving towards that inflection point of becoming profitable, and not only becoming profitable, but also being able to increase their profit through increase in receipts and revenue. So beautiful increase in receipts over time. It's gone from 760,000 from when I started following this company when they IPO'd, all the way up to $11.6 million in one quarter. Now, it's not perfect. There have been times, small periods of times, when receipts have gone sideways. You can see between the September quarter 2019 and the December quarter 2021, receipts went sideways. So that could have been concerning for shareholders, but then receipts started to grow again. So small periods of time when receipts might do nothing. But if you draw a line of best fit here, you'll be able to see there's definitely a growth in receipts. And that's the main thing I'm looking for in companies like this. And the other reason why I want to see receipts growing or revenue growing is because the best way to get earnings per share growth is through revenue growth. The other two ways to get earnings per share growth is to, if you don't have revenue growth, is to have increasing margins, which is not sustainable for the long term, and have decreasing spending, which again is not sustainable for the long term. Do you know what is sustainable for the long term? Revenue growth. So that's another reason why I'm always looking for receipts and revenue growth for a company, and Volpara has a massive tick when it comes to that. And this is Volpara's operating cash flow going back to the second quarter of financial year 22. This is straight from the company's Appendix 4C. I did not draw this up. I didn't make this up. This is straight from the company. And it's pretty obvious why they wanted to include this within the commentary, because it really shows the company hitting that inflection point about 1 year ago between the second quarter of financial year 23, when they burned through about $3 million of cash in operations, to the third quarter in financial year 23, when they generated about $2 million in operations. So that was a turning point for this company, in my opinion. However, the market really hasn't reacted at all to this inflection point that the company has experienced. And I still don't know why I haven't taken a position in this company, because I do like the company for the long term. And maybe just doing this video will prompt me to eventually take a position in this company, because I do think you will see operating cash flow and free cash flow and the profitability of this company increase from here. Now let's have a look at some charts. We'll have a look at the weekly chart first. This is the chart going back to when they listed on the ASX. And then the next slide, we'll look at the daily chart. And the weekly chart looks pretty interesting. Now, the share price from when they listed to right now has increased, but it's been quite a journey. In fact, the share price reached a high of $2.20 in late 2019, just prior to the COVID-19 financial panic. During the COVID-19 financial panic, share price actually did drop to about 70 cents. And then, of course, there was a V-shaped recovery in the share price. But the share price has fallen below the COVID-19 lows. So right now, even though the company is in better financial shape, particularly compared to 2019, just the overall sentiment in the market around these companies has driven the share price and the valuation of this company down significantly below the COVID-19 levels. Share price, in fact, went as low as about 40 cents in June 2022. Now, if you look at this particular chart from June 2022, there is a bit of an uptrend developing. You could argue there is an uptrend, because if you connect all the lows and each successive low is higher than the previous one, that's a definition of an uptrend. I probably would like to see each successive high being higher than the other one, and possibly we're seeing that as well. But the share price has fallen a lot since the most recent high, which was produced or produced or made in July of this year. You're able to see that when we look at the daily chart. And there was a little bit of hype, renewed interest in this company back in July, only 3 months ago. I'm not sure exactly what caused that renewed interest, but the share price has significantly decreased from there. So let's have a look at the daily chart right now. And as we take a look at the daily chart, this goes back to September 2022. Share price has not done much. If you take the first day of this period and the last day of this period, share price has increased a little bit, but you can just see the flows and ebbs of the share price through time. It's like a wave. You have peaks and troughs. Ideally, what you want to see is the peaks. Each successive peak is higher than the previous one, and each trough is higher than the previous one as well. That's the definition of an uptrend. And you sort of do see that on this particular chart. Now, we have seen the share price really struggle since the last time we saw that peak in July of this year. Share price went to a high of $1.05. And the share price has tumbled a fair bit from $1.05 to about 62 cents. And the problem this company experienced when they released their Appendix 4C is the share price had been significantly higher than what the share price was on that day. So even though the share price rallied 18% on pretty good volume, when the company released their Appendix 4C, there was just too much demand or too much supply of shares entering the market on that day and following days. And that's why the share price took a tumble, particularly a few days later on some, wouldn't say massive volume, but there was just too much selling happening. And the reason there was a lot of selling happening, a lot of supply of extra shares on the market, is because of many shareholders had bought in Volpara at higher share prices over the past 9 months. You see the share price going sideways between January and June. And a lot of those shareholders bought shares of this company around about 75 cents. And when the share price got to 76 cents on October 17, a lot of those shareholders said, oh, now I can sell Volpara without taking a loss. And that is extra supply. Even shareholders who bought during July when the share price went on a bit of a run, they said, well, I can now sell Volpara, my Volpara shares at not as big of a loss. That's extra supply. It's one of the reasons why when a company releases a good financial report like Volpara did, and there is a potential breakout, share price increases 18% on good volume, I want to see the share price at the end of trading on that day to be at least a 6-month high, preferably over a 1-year high. And the reason behind that is you have less resistance because you have to understand the psychology of individual investors. And if you understand the psychology of individual investors, you can understand the psychology of the overall market. And that is why Volpara's share price has struggled since they released this Appendix 4C. And that is all I have for this video, looking at Volpara's final Appendix 4C. 4 quarters of positive operating cash flow means they don't have to release any more Appendix 4Cs, but the management has informed us that they will continue to update their investors and the market on a continual basis, but not Appendix 4Cs. If you have any questions about Volpara, if you like this company, if you're a shareholder of this company, I'd love to hear your opinion on this company. So leave your thoughts in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.